So when Deutsche Bank needs a little money and they borrow from JP Morgan, or Citi lends to Credit Suisse, or however, UBS, Unicredit, however it plays out, that's all in the Eurodollar market. But the rates are very short term, overnight, 1 week, etc. But that's what banks use to leverage their balance sheet. That's what banks use to support their derivatives positions. That's what banks use for collateral. And if I'm going to have a derivatives position, I have to give you collateral. And this symptom of a liquidity crisis is when you say, yeah, okay, Jim, I'll take the collateral, but I only want treasury bills. I don't want your junky mortgages. I don't want your corporates. If you give me a 10-year note, I'm going to give you a 1-point haircut, which is a lot. I want 30-day bill. I want your best, absolute best collateral. And even then, there's a little bit of a haircut. So if I have to get that collateral to pledge to you to leverage my balance sheet so I can make money, I need dollars. If I'm Deutsche Bank, I need dollars to buy treasury bills. Can't buy them with euros. And this is the secret of why the dollar is so strong. Everyone's like, wait a second. You guys got, multi-trillion-dollar deficits. You got 130% debt to GDP ratio, which is about as high, almost as high as Lebanon. Your budget's out of control. Your inflation's out of control. Your politics are dysfunctional. Everything's bad. Why on earth would the dollar be so strong? The answer is, behind the curtain, people need dollars to buy dollar-denominated collateral to support their balance sheet. So that's the secret driver there. Now, what's going on with the Eurodollar futures curve? Now, you can trade Eurodollar futures on the CME, and they go out, I think they might go out to like 8 or 9 years or 10 years, but most of the liquidity obviously is in the early months. But the 2 and 3 year, 4 year futures trading is relatively liquid. Certainly 2 years is very liquid. And they settle monthly, and then as you get to long maturities, quarterly, et cetera. So there's a Eurodollar futures curve. Now, how to think about this? And this is interesting. These are long-term bets on short-term rates, right? Because if I buy a Eurodollar futures 2 years forward, I'm making a 2-year forward bet on what overnight rates are going to be 2 years from now. So easiest way to understand it, long-term bets on short-term rates. The Eurodollar futures curve is inverted. Again, normally sloping at the short end, and then it goes inverted, steeply inverted. So that's telling you that not only does the treasury market think 10-year note yield to maturities are going to be lower 2 years from now than they are today, but the Eurodollar futures market is telling you overnight rates, the rates the Fed does control, are going to be lower 2 years from now than they are today. And just to make it worse, that kink, the inversion point, the inflection point, is moving in. Like we had this conversation 6 or 8 months ago, I would have said, hey, Brian, 3 years from now, the curve's inverted. Well, it's becoming in 2 years. Now the inversion starts, the inflection point is kind of January 2023.
Okay, so that's telling us.
I'll just wrap it. So the largest, most sophisticated, biggest player, real money market in the world is telling you that the Fed's going to blink, that they're going to raise rates probably through the remainder of this year, but then things are going to get so bad, they're going to have to cut rates. And that's why we can see a liquidity crisis and a very severe recession coming well in advance.